The UK rental market is undergoing a profound transformation, and tenants are experiencing challenges that many experts argue are the most severe in decades. Across the country, households are facing sharply rising rents, declining availability of properties, and increasingly complex conditions that are making renting both expensive and uncertain. Major urban centres, including London, Manchester, Birmingham, Leeds, and Edinburgh, are at the epicenter of this crisis, with rental prices increasing at rates that often outpace wage growth, creating significant affordability issues. In London alone, certain central boroughs have seen rent increases exceeding 10% year-on-year, while even suburban and commuter belt areas have faced substantial rises of 5 to 7%. These figures illustrate a structural shift in the rental market, where demand is increasingly outstripping supply, and economic pressures are being transferred directly to tenants. One of the primary drivers of this crisis is the reduction in rental stock. Over the past several years, many private landlords have chosen to exit the market due to rising operating costs, increased taxation, and tighter regulatory requirements. The buy-to-let sector, which historically provided stability and investment capital to the rental market, is now facing significant challenges. Changes in tax relief on mortgage interest, combined with increased compliance and maintenance requirements, have made managing rental properties less financially attractive. Consequently, landlords are selling properties, reducing portfolios, or converting them to alternative uses, directly impacting the number of homes available for rent. This reduction in supply has a ripple effect. As fewer properties become available, competition among tenants intensifies, driving rents higher and forcing renters to compromise on property size, quality, and location. The situation is particularly acute in areas with historically high demand, such as university towns, urban centers, and popular commuter zones. At the same time, older tenants who might consider downsizing or relocating are often constrained by limited rental options, further tightening the market for younger renters and creating bottlenecks in property availability. The decline in rental stock is compounded by policy and regulatory changes affecting both landlords and tenants. In recent years, the UK government has introduced reforms designed to enhance tenant protections, improve housing standards, and regulate deposit practices. While these measures aim to protect renters, they have also increased the administrative and financial burden on landlords. Stricter compliance requirements, mandatory property improvements, and more rigorous tenancy laws have led some landlords to sell their properties or reduce their portfolios, contributing to the reduction in available rental stock. For tenants, the combination of rising costs and limited supply means that securing suitable accommodation has become more competitive and challenging. At the same time, many renters remain unaware of their rights under these new regulations, which can leave them vulnerable to disputes regarding deposits, repairs, and lease terms. Knowledge gaps in tenant protections further heighten the stress and uncertainty experienced in the rental market today. Another significant factor driving the rental crisis is the broader macroeconomic environment. Rising interest rates and inflation have affected household budgets across the board, creating pressure on both tenants and landlords. Prospective homeowners, priced out of the property market due to increased mortgage costs, are turning to the rental sector, further driving up demand and intensifying competition. Meanwhile, landlords face higher borrowing costs, maintenance expenses, and general operational challenges, leading them to adjust rents to maintain profitability. This dynamic creates a cycle in which tenants face higher rents and reduced options, while landlords grapple with increased costs and tighter margins. The interplay between macroeconomic pressures, rising rents, and constrained supply has created a situation in which tenants feel the direct impact of broader economic volatility more acutely than in previous decades. Demographic shifts have also contributed to heightened pressure on tenants. Younger generations, including millennials and Gen Z, are entering the rental market later than previous cohorts, often due to student debt, high property prices, and employment uncertainty. This generation's prolonged reliance on renting has increased competition for properties, particularly in urban centers and areas with established rental demand. At the same time, older tenants who might downsize or relocate are constrained by affordability and limited availability of suitable homes, reducing the natural turnover of rental stock and creating additional pressure on the market. The resulting imbalance between high demand from younger renters and limited availability due to older tenants and exiting landlords has intensified competition and driven rents upward, marking a significant departure from historical rental patterns. Tenant experiences are increasingly impacted by these converging challenges. Surveys and reports indicate growing dissatisfaction among renters, with many expressing frustration over rising costs, limited choice, and insecure tenure. Frequent moves, driven by rent hikes or the end of lease agreements, disrupt household stability and create uncertainty, particularly for families, students, and professionals relocating for work. Additionally, tenants may face difficulties securing properties in desirable locations, forcing them to compromise on amenities, commute times, and neighborhood quality. These conditions not only affect affordability but also the overall quality of life for renters, highlighting the severity of the current rental market crisis. Investment trends in rental property further influence tenant experiences. Buy-to-let investors are now more selective, targeting areas with strong rental yields, lower regulatory risk, and stable demand. Institutional investors, previously significant stabilizers of the market, are adopting more cautious acquisition strategies, reducing turnover in rental stock. This reduced investment activity in certain regions limits tenant options, increases competition for available properties, and contributes to upward pressure on rents. For tenants, the combination of fewer landlords, limited investment, and high demand creates a market environment that is both competitive and financially challenging. A primary driver of continued rental market stress is the broader economic climate. Inflation, which has remained elevated in recent years, is significantly eroding household budgets. Energy prices, which spiked dramatically over the past several years, continue to be a major burden for tenants, particularly in urban centers and older properties with less efficient heating systems. Transportation costs, groceries, and general living expenses have also risen substantially, leaving tenants with less disposable income to meet rent obligations. In many cases, wage growth has failed to keep pace with inflation, particularly in sectors dominated by younger professionals, entry-level positions, and part-time work. The result is a scenario where tenants must allocate a larger proportion of their income to housing, often exceeding recommended affordability ratios, creating financial strain and increasing vulnerability to unexpected expenses or life events. Interest rate fluctuations have also played a critical role in reshaping tenant pressures. As mortgage rates rise, some prospective buyers are priced out of home ownership and turn to renting as the only feasible housing option. This influx of would-be buyers into the rental sector increases competition for limited properties, further driving rents upward. Simultaneously, landlords who face higher borrowing costs and interest payments on their own mortgages are compelled to increase rents to maintain profitability, creating a cyclical effect where macroeconomic policies directly influence tenant affordability. The interplay between interest rates, mortgage availability, and rental demand is complex, but its impact on tenants is clear. The cost of renting is rising, often faster than household incomes, and market predictability has diminished. Demographic trends intensify these pressures. Millennials and Gen Z, burdened with higher student debt and delayed entry into homeownership, are spending longer periods renting, increasing demand in urban centers, commuter towns, and student housing markets. This demographic reliance on the rental sector is occurring simultaneously with a slowdown in rental stock availability. Older tenants, who might otherwise downsize or relocate to less expensive areas, are constrained by limited suitable options, affordability challenges, and preferences for established communities or proximity to services. The combination of high demand from younger renters and low turnover from older tenants creates a bottleneck, intensifying competition for available properties and putting upward pressure on rents. The rental market is therefore not only more competitive financially but also socially, as tenants must navigate limited availability alongside demographic pressures. Policy and regulatory frameworks also directly impact the rental environment. Recent reforms aimed at improving tenant protections, regulating deposits, and increasing housing standards have had the unintended consequence of reducing rental supply. Stricter compliance requirements, property maintenance standards and legal obligations increase costs and operational burdens on landlords, prompting some to sell or convert properties. While these policies improve protections for tenants in theory, the reduced availability of rental stock exacerbates affordability challenges, particularly in high-demand areas. Tenants who are unaware of their rights under these regulations can experience disputes over deposits, repairs, or lease terms, adding further stress to an already pressured housing environment. Effective tenant advocacy, education, and awareness are therefore more critical than ever to navigate the regulatory landscape and secure stable housing. The rental market is also shaped by shifting landlord and investor behavior. Institutional investors, who historically stabilized rental supply by purchasing multiple units and maintaining long-term leases, have become increasingly cautious. Factors such as rising interest rates, higher operational costs, and regulatory uncertainties have led to slower acquisitions and selective investment strategies, particularly in regions with lower rental yields or higher perceived risk. Individual buy-to-let investors are similarly constrained, often reducing their portfolios or exiting the market entirely. Reduced investment activity limits the availability of well-maintained, professionally managed rental properties, placing additional pressure on tenants and forcing them to compromise on quality, location, or affordability. Regional disparities further complicate the tenant experience. Urban centres continue to experience the most acute pressure, with central London and other major city hubs seeing the highest rent increases and most competitive markets. Suburban and commuter belt areas, while slightly more affordable, come with trade-offs, such as longer commute times, fewer local amenities, and limited public transport options. Regional cities, including Manchester, Birmingham, Leeds, and Edinburgh, are also experiencing upward rent pressures, though often at slightly lower levels than London. Tenants navigating these regional variations must carefully assess the trade-offs between affordability, convenience, and long-term sustainability. Understanding local market trends, transport links, employment opportunities, and neighborhood amenities is critical to securing a rental property that meets both financial and lifestyle needs. Social factors compound these pressures as well. Families, students, and professionals relocating for work face heightened challenges, with limited rental options and intense competition for desirable properties. Frequent moves, often caused by rent hikes or lease expirations, disrupt household stability and increase the costs associated with moving, including deposits, agency fees, and transportation. Tenants increasingly report stress, uncertainty, and dissatisfaction with their rental experiences, highlighting the human impact of structural market pressures. For many, these conditions represent the most difficult rental environment in decades, requiring resilience, careful planning, and strategic decision-making to navigate effectively. In addition to affordability and availability, property quality has become a growing concern. As landlords navigate financial pressures and regulatory compliance, some properties experience deferred maintenance or reduced investment in improvements. Tenants may encounter issues such as inadequate heating, outdated appliances, or poor insulation, which not only affect comfort but also increase energy costs. In high-demand areas, tenants often have little choice but to accept these conditions, further contributing to dissatisfaction and financial strain. Professionals entering the rental market must balance price, location, and quality considerations carefully, as compromises on one factor often have cascading impacts on living conditions and long-term affordability. Tenant dissatisfaction is now at unprecedented levels. Surveys and reports consistently indicate that renters are frustrated with escalating costs, limited options, and the instability of tenure. Many tenants face frequent moves as landlords increase rents or choose not to renew leases, resulting in disruption to work, schooling, and daily life. For families, this often means moving multiple times within a short period, creating stress and logistical challenges. Students and young professionals relocating for education or employment face similar uncertainty, sometimes paying disproportionately high rents for properties that fail to meet their needs in terms of size, quality, or location. The combination of financial pressure and insecurity is eroding overall quality of life for renters, marking this period as one of the most difficult in recent memory. Regional disparities further intensify the challenges for tenants. Urban centers, particularly London, remain the epicenter of rental stress, with central boroughs experiencing some of the steepest rent increases and the most competitive market conditions. Suburban and commuter areas offer slightly more affordability, but often come with trade-offs, including longer commutes, reduced access to amenities, and fewer employment opportunities. Regional cities such as Manchester, Birmingham, Leeds, and Edinburgh are also feeling significant strain, with rents rising steadily and available stock limited. For tenants navigating these disparities, careful planning and flexibility are essential. Understanding local market conditions, upcoming infrastructure projects, and neighborhood trends can help renters identify areas with relative stability and better long-term prospects. Without this knowledge, tenants risk paying inflated rents or securing properties that may not meet their needs over time. Property quality and maintenance remain critical issues. Rising costs and regulatory requirements have pushed some landlords to defer maintenance or reduce investment in property upgrades. Tenants increasingly encounter poorly insulated homes, outdated heating systems, and properties that fail to meet modern living standards. In high-demand urban areas, renters often have no choice but to accept substandard conditions due to limited options. This has a direct impact on living costs, as inefficient properties increase energy bills, and on overall well-being, as tenants contend with noise, overcrowding, or lack of adequate space. For many renters, these conditions compound the financial strain caused by rising rents, creating an environment where affordability, comfort, and quality are simultaneously under pressure. The financial burden on tenants is further compounded by hidden costs. Agency fees, security deposits, utility bills, and moving expenses can significantly add to the overall cost of renting, particularly when frequent relocations are necessary. With rents rising faster than wages in many regions, tenants are often forced to allocate a disproportionate share of their income to housing, leaving limited capacity for savings or investment. Younger tenants, particularly those entering the workforce for the first time, are disproportionately affected, while families may need to adjust lifestyle choices, delay education, or cut back on discretionary spending to meet housing obligations. These pressures highlight the importance of financial planning and strategic decision-making in navigating today's rental market. Investor behavior has played a central role in shaping tenant experiences. Many buy-to-let landlords have become more selective, focusing on properties with higher yields and stable demand while exiting riskier or less profitable areas. Institutional investors, who historically stabilized certain rental markets by maintaining multiple units and long-term leases, have adopted more cautious acquisition strategies. Reduced investment activity in certain regions limits property turnover, driving up competition and rents. Tenants are therefore directly affected by changes in landlord behavior, with fewer options, higher prices, and greater pressure to compromise on property quality, location, or affordability. Policy and regulatory factors continue to shape market dynamics. Reforms intended to protect tenants, such as deposit regulations, enhanced property standards, and increased transparency requirements, have sometimes had unintended consequences. While these measures improve tenant security in principle, they have also increased operational costs for landlords and contributed to reductions in rental stock. Tenants who are not fully aware of their rights may struggle to enforce protections related to repairs, deposits, or lease terms, adding another layer of complexity to an already constrained market. Staying informed about legal rights, property standards, and regulatory changes is therefore critical for renters navigating this challenging environment. Social and psychological impacts of the rental crisis are significant. Frequent relocations, affordability stress, and uncertainty about future housing options create anxiety, disrupt family life, and affect community cohesion. For many tenants, the rental market no longer represents stability or security, but rather a series of compromises and financial pressures that limit long-term planning. Young professionals may delay career relocations or avoid certain areas due to housing costs, while families may opt for overcrowded or suboptimal properties to maintain affordability. These challenges underscore the human dimension of the crisis, which extends beyond economics into quality of life and social stability. Looking forward, strategic planning and informed decision-making are essential. Tenants can mitigate risks by carefully evaluating local market trends, considering flexible locations, understanding their legal rights, and planning for future financial obligations. Long-term strategies may include building savings for eventual home ownership, seeking professional advice on tenancy agreements, and prioritizing properties with stable landlords and reputable management. Awareness of regional dynamics, regulatory changes, and economic pressures allows tenants to approach the market proactively rather than reactively, improving the likelihood of securing affordable, suitable, and stable housing.